All right. Hello, everyone, and thank you for continuing to join us throughout the day here at the Lytham Partners Spring 2025 Investor Conference. Again, my name is Robert Blum, managing partner here at Lytham. For our afternoon panel titled Navigating the Undercurrents, Small Cap Strategies for Top Money Managers, I'm pleased to be joined by three individuals who've been involved in the micro and small cap markets for a number of years now. Each of them, in fact, were portfolio managers at firms that were running multi-billion dollars, but today run their own funds, bringing unique insights and experience from really decades in the market. Today, we're joined by Andrew Rem of Odinson Partners, who spent more than a decade with Nuveen as a portfolio manager running their small cap value fund. JP Gurnee of Gurnee Group, who spent time as a portfolio manager at BMO, which was later acquired by Columbia Threadneedle. And finally, Chris Abbott of 1035 Capital Management, who's joining us again, is over a decade of experience in the small cap space and formerly at Argent Capital Management. So, gentlemen, thank you so much for your participation in today's conference and our panel.
Thanks for the invite.
Yeah, thanks
And
for having us.
Thank you. Thank you.
fantastic, guys. Let's jump right in. Let's talk about some of the industries or sectors that you believe are best positioned for growth in the small cap space over the next few years. And Chris, why don't you begin?
Well, I think energy has got to be an interesting one, especially with you see the explosion of data centers and the associated energy demands there. And you've got, of course, Trump and drill, drill, drill. I'm not necessarily a big fan of oil per se because of that drill, drill, drill. That implies kind of more supply, lower prices. Uh, I think I've mentioned this in the past, but one of the areas I've been really interested in and spent a lot of time on is nuclear energy, specifically around the refining, not so much the mining. So that's really continues to be an interesting theme. And then, of course, recently the Trump administration pointing that out as well. So,
All right, very good. JP?
Yeah, one area that we've been spending some more time in is on the healthcare side, in particular. Well, really across the different innovative parts. So whether it's devices or even biopharmaceuticals that have commercial assets, we think there's a lot of opportunity for innovation there, and we've seen that in the last few years. We've also seen some of the large companies kind of get away, and I'm talking about like the big pharma and big device companies get away from innovating themselves and basically have been able to take advantage of a lot of the smaller companies innovating. We've seen a few companies in the last few years that kind of get to that 100 and 200 million dollar revenue and ultimately are acquired. We just think there's a lot of interesting opportunities down in these little tiny micro cap companies that people haven't heard of that ultimately get acquired for their great scientific prowess. And we see that trend continuing to happen. A lot of these companies have nice revenue streams and decent earning streams as well. So they actually provide some nice downside protection despite also having a lot of upside potential through their innovation. So we've been spending time there, and hopefully that will continue to play out in the next couple of years.
Fantastic. And Andrew?
Yeah, and I'm not sure if this is industry per se, but I like situations that are about efficiency. So I guess a topic a lot of people are focused on currently is AI. And so I kind of break that into two components, which would be who are AI players. So that's one way you can think about it. And another way is what are businesses or industries that can really take advantage of AI? What are industries that, and there's a positive and negative impact inside that, right? And then what are industries that you wouldn't really see much impact from AI at all? So that's one thing. And then like with efficiency, it's just like when I come across a manufacturing or an industrial business who's not doing lean, so lean manufacturing, or people say lean Six Sigma.
Yeah.
If they are going to start or very early in their journey, there's a ton of good things that can happen behind that. And so I think, technology can get you more efficient. Lean as kind of a culture can get you significantly more efficient. So I like situations that kind of set up like that, where efficiency can have be a long-term tailwind for the business and or the industry.
I love sort of the diversification here of ideas from all of you, and it's what makes this industry so unique. Let's talk about some of the risk appetite, especially in the small caps, right? I mean, over the last number of years, maybe generally hasn't been as strong as it had been, although things have rebounded somewhat. Talk about maybe what the risk appetite is today versus a few years ago, and maybe some of the biggest risk factors that you're monitoring for your portfolio right now. And maybe Andrew, I'll give you the first one here.
Yeah, I'm gonna have to be careful. This is one I'd love to talk about a ton. So I break, and this is like people have already done this. So I'll break out. There's a difference between volatility and risk. And volatility is just kind of short-term price action in the stock or in the market. And then risk is being defined as permanent capital loss. So when I think about volatility, I think you have to parse it into some pieces. One is volatility. Everyone loves upside volatility. So we can all agree on that. And so when you talk about volatility, it's really just downside volatility. And oftentimes downside volatility is driven by some uncertainty. And I don't know if today is more or less volatile than it's ever been. The market historically has gone through big gyrations in volatility. So when I think about volatility, the question that I'm asking myself is first and foremost, is or isn't this an opportunity in an individual name? When it comes to risk, I think part of your question was like, how is your risk appetite changed? My view on risk has continued to evolve through time. And I guess another element that sits in all of that relevant to microcaps is liquidity. And I think people tend to have this natural view of liquidity that, illiquidity is bad and high liquidity is good. And I would say I guess I want to be PG-13 here. If you think about 2009 or 2008 and the crap was hitting the fan, I lived in an environment where you sold what you could, not necessarily what you wanted to. So what got sold first? The most liquid stuff. And I think that's like in microcaps, that can be an advantage. It's context dependent. But I think sometimes people forget that in the worst of it, especially in a macro downdraft, illiquidity can actually be your friend. And the other thing that I think is true in microcaps is people think that because it's illiquid, we can't own it, blah, blah, blah. Execution followed by price solves liquidity problems. And people, I think, tend to forget that as well. So not sure I've done a good job of answering your question, but some of the things I think about as it relates to kind of volatility and risk.
No, it's helpful. Chris.
Well, I actually kind of agree with Andrew, although I'll say I have a feeling and a theory that I think risk and volatility in the market is generally going up. I think part of it is because you have more algorithms, more fast money that's moving in and out. And frankly, when things get uncertain, they turn off their machines and the liquidity that they once provide goes away, causing bigger moves. And then at the same time, you see more and more passive investors. And it's kind of a risk on, risk off decision versus I like this stock or I don't like this stock. And as you see more and more of the, let's say, total investment become passive, it's more of a risk on, risk off decision versus should I buy this individual company? And as a result, you see increased volatility. How does that work into my world? I find it to be a great opportunity. Okay, so like you look at the COVID or 08, 09, no shortage of things were on sale at unreasonable prices. And this happens fairly frequently in small cap. It's happened, in my opinion, over the last 3 or 4 years, while small cap and micro cap has just been brutalized due to concerns around interest rates and refinancing. this is about as fertile a ground as I've seen for a long time in small and micro cap, and the general market's risk appetite towards it is quite low, which is perhaps unsurprising, right? It's very much what have you done for me lately, and small caps have done nothing for me lately. But we should be getting to the other side of the boat, in my opinion, now, talking my book as a small cap guy. But I do see a lot of interesting opportunities and value in small cap right now, and it's actually led me to more concentration. So I'm in a much more concentrated portfolio than I was 2, 3 years ago. So.
Interesting. JP, any additional thoughts there?
Yeah, maybe I'll just build on something Chris said. So we use some quantitative tools in our investment process. We'll use a combination of qualitative analysis, quantitative tools, and when we look quantitatively through some of the database we have on return streams over the long run from the Fama French database, nearly 100 years of trailing data, we actually see right now, kind of Chris, you just touched on this, but the valuations of some of these micro cap assets, small cap assets, profitable assets, we actually see their discounts as great as they've been basically over the last 100 years. There have been 2 or 3 other periods like this, but this is just about as bad as it's gotten. And by the way, these are profitable companies. These are not a mix of both profitable and unprofitable. These are just the profitable assets. So basically, when I think about your question, how are we approaching risk? We can find some volatile stocks and volatile companies where there's great opportunities for upside. But also the valuation being assigned to just these profitable, slower, kind of moving, just stable businesses. We think the spread and the opportunity there is as good today as ever. And so we're just really excited about that on a go-forward basis. We don't know when that spread will unwind compared to large companies, but we just do think that the absolute return opportunity in just lower risk, small cap profitable stocks, we think that's a pretty attractive setup these days. So, there's always opportunities in more emerging places in small cap as well. But we really have been leaning into the opportunity just in profitable, stable operating businesses on the small side, which we think are priced at a pretty deep discount.
So JP, maybe to build off that a little bit, and the whole idea of value versus growth, and value can be defined in many different ways. Are you sort of skewing your portfolio one direction or the other? Because are growth names that are profitable sort of just at such severe discounts that you're moving more in that direction, or is it the value names that are just incredibly cheap right now that you're jumping into more?
The way that we're positioned, basically what we try and do is relative to the overall market, we try to be at a cheaper valuation and more profitable just company base overall, and even maybe a little more growth even. And we come up with that recipe through using some of these quantitative tools. So this question about growth versus value, we see opportunity on both different types of companies. We use the tools to help us identify those. And ultimately, it just comes down to traditional underwriting of these assets. Are they trading at a discount to their intrinsic value? So I don't know if that can, if that's value investing or growth investing. Maybe it's a little bit of both. But in that strategy, works regardless of the environment. But right now we're finding interesting opportunities in companies that are growing fast. But we're also finding good opportunities in companies that are technically more value companies, but generate significant cash flow. And we think we're picking up at good prices. We kind of see good opportunity across the board. I mean, I guess there's been times in the last 5 or so years where one looks more attractive than the other from a style perspective. But I'd say right now we're seeing pretty good opportunities on both styles. I don't know if Chris and Andrew would agree, but that's the way we're thinking about it.
Well, and Andrew, when you were at Nuveen, you were running a small cap value fund, right? I assume you had sort of a little bit more specificity in terms of types of companies you had to invest in, because there was also other large funds focused on other areas. Where you're at today, are you still sort of focused on that, or have you sort of, to JP's point, across both sides of the spectrum?
Yeah, I think I feel like one of the beauties of what I'm doing today is I actually don't have to discriminate between value and growth. And in my prior life, where I started was actually on a growth fund. So I've I've done both, right? Value and growth strategies. And I would say now I'm quote unquote style agnostic. And I'm really, I mean, in the core of the portfolio, yeah, they are, I'm I'm very valuation sensitive, which I don't mean that to mean that I'm only investing in value businesses, and probably my tilt is toward businesses that are growing at a reasonable to fair valuation. So it might actually be more GARP-ish in nature. But I'm also, when I was on a growth strategy, we needed things that were going to grow at 15%. That was minimum top line growth. And today I would say that's awesome. 15, 20, 30%, that's great. I'm also very comfortable owning grinders. So companies that just kind of consistently get it done, because over time, those, if it ends up being a very consistent business, at the end of the day, I really just want to compound wealth, right? And so there's multiple different ways that you can do that. And then I would say on the margin, I always am sensitive to, I'm going to call them special situations, but turnaround situations, shorter duration. So things that I think the valuation can play out in my favor over a relatively short period of time versus the core portfolio where I really want to be able to own things in size for longer periods of time.
That's helpful. Chris, you're much more concentrated, right? And I know some of the names that you're involved in here, but how do you characterize sort of the style that you're looking at right now? Is there a one size fits all?
Well, I actually explicitly run my portfolio as a core portfolio, but I pick growth and value names and mix them together to get a core portfolio with better than Russell 2000 growth, better than Russell 2000 valuation. So I mix the two together. That's always the way I've done it. I try to get a little growthier and a little cheaper. Now, that doesn't necessarily mean that every stock that's a growth stock is cheap, and not necessarily every value stock is cheap, because the way I look at value is, I guess I'd align it with what Andrew called special situations. So I'm looking for deep value, sum of the parts, uh, maybe a cash flow return story, spin-offs, that kind of different things. And then on the growth side, frankly, I'm too cheap to pay up. So I find myself in kind of a disruptive growth at a reasonable price, is the way I term it. And typically what that means is I end up being earlier when it's a little riskier in this company's history. Let's say I like the situation and I've become more constructivist where I get involved in my companies. It's a little bit earlier in their disruptive growth mode. And I can come in there and help them with connections, allocation of capital, things like that, and really influence the outcome by being a helpful partner versus a passive investor.
Yeah. JP, a couple of things you touched on is sort of, I forget the term you used, some of it wasn't algorithms, but you sort of have your techniques in which you're sort of utilizing construction of the portfolio or looking at different screens and tools and things of that sort. When you sort of, and I'll ask each of you guys here, when you sort of break down your approach to researching publicly traded companies here and investments, is it sort of starts with top down? Is it coming from doing conferences, company visits, sell side analysts perhaps that are sending research out there? What are sort of the main tools that you're utilizing here today?
Yeah. So the quantitative tools that we use are really, really helpful in this particular universe. So I contrast it with our time managing large cap assets at prior firms. And in the large cap investable universe is perhaps 500 stocks or maybe 1,000, depending on how you define it. With this particular micro cap equity universe, there are over 2,000 opportunities. And so that's really special, I think, because there's always something to look at, and things are always changing. Prices are moving every day. So we use the quantitative front end to basically screen all these companies on a daily basis. And we have a model we built that basically is tuned on certain factors that we think are predictive of future excess returns. And so it's simple things and more complex things. On a simple basis, just purely the profitability of the business. Profitable companies tend to outperform unprofitable companies over a long run. So we have simple things like that. We have a little more proprietary factors that predict future excess returns. We roll that all together, and that's our starting point. From there, quantitative modeling is great. Lots of breadth in the microcap universe. Lots of different factors you can use. There's so much data out there. I mean, we're inundated with data. Everyone is. But you can't just trust the numbers. You have to bring a little bit of a human touch to it. And so at that point in time, we like to meet the companies, create our own forecasts, meet the company's competitors, and to that end, we use great conferences like Lytham Partners conference that we're going through right now, and others in the space, really to underwrite these businesses on a deeper level and get to know them a little closer. And then over time, we build a working knowledge there, and that becomes the basis for our fundamental evaluation of a company.
Great plug and open invitation to all future conferences now, JP.
Yes.
Chris, I know you've got sort of your tools and such. Maybe expand upon that.
Well, like JP, I actually have built a pretty robust quant front end to help filter through a lot of the noise. Because to your point, there's I almost say an unlimited number of companies to look at. Because it's not just the Russell 2000. There's all sorts of stuff that's outside of it, and my mandate doesn't prevent that. So I do as well. I do quant screening a fair amount of it. You can get a lot of the data that I do on Substack. I put it up on Substack for people. But I would consider myself agnostic as to where my ideas come from. I spend a lot of time talking to people. I go to conferences like the Lytham conference. Robert, I've been an attendee for a long time. But I really, really dig in, and I spend a lot of time with management teams to the point where sometimes I think they might think I'm attached to them at their hip. And I would like to be in some cases. So I get a lot of time with the management teams. I talk to competitors. I've got a good group of acquaintances, friends in the business that have been around for a long time that I bounce ideas off of. I'm always looking for them to poke holes in them. And it's amazing. It's amazing how smart these people are and how quickly they come up with, have you thought about this? Have you thought about this? And often the answer is no. And then you've got a new line of research. So, I mean, from my perspective, it's a little bit of everything is how I come up with an idea. But once it gets past the interesting part, then it's digging in, and I'm in the conferences. I'm talking to the management teams regularly. I'm on the earnings calls. I'm doing my own modeling, talking to competitors. It's kind of the typical gamut you would do as a fundamental investor. So,
Andrew and Chris, you're also invited to all future conferences here as well.
Appreciate it. Thank you.
Yeah, probably a lot of what Chris said kind of resonates with me. I think the one thing that obviously the JP and Chris are way smarter than me, because although I do screening, I would say it's rudimentary, and I've probably moved away from doing screening other than, I will do a screen towards profitability or a universe that is closer to being profitable. But I'm probably tilted, and so I said earlier, kind of tilting away from screening. I'm trying to figure out different or maybe esoteric ways to not screen in the traditional sense. And so when I say that, like screening on growth or margins, those types of traditional, or what I would view as traditional screens, and is there more esoteric ways that I could quote unquote screen? Because I think one of the things I landed on at the end of last year was I need to tilt my process to try to find things early. And I don't think, for how I kind of defined early screening so far, the traditional methods don't quite meet that. But the other things that, both of these guys talked about, the virtual conferences, Lytham is awesome. I think as a small investor, virtual conferences, I think, is a boon for microcap investors. It's a nice way to see companies. It's a nice way to get a first introduction to companies. JP and Chris both talked about talking to management. I love that. And I think the area So one is I'm trying to get better at finding things early and trying to develop my own tools for doing that. And then I would say the other thing I'm trying to get better at is I guess Chris touched on it, but it's kind of the sleuthing, right? The talking to competitors. I'd like to do more industry conferences. So we've talked a little bit about investor conferences, but pick an industry, they all have their own trade shows. And so I'd like to do like more of that. But I love going out and visiting companies, right? See how the sausage is made. Super fun. And there's a ton of intangibles. People talk about, does the CEO have a named parking spot, and do they drive a Porsche, and what does the office look like? And those sound kind of rudimentary, but there's a ton of stuff that you can pick up in a site visit that you don't pick up even in an in-person meeting. So anyway, yeah, that's some of the things.
So maybe building off that and starting there with you, Andrew, as you're going through and you're doing these in-person meetings, you're doing virtual meetings, you're visiting companies here. I assume that there are some major red flags. You just sort of mentioned a couple of things that you're sort of thinking about. What are some of the biggest red flags that you're looking for, that when that comes out of the person's mouth, or you see something, you just sort of, you go on your sheet, your database, whatever it is, and you kind of put a red X or whatever it might be and say, I don't know what this company reports. I don't care what comes out. I'm just not going to touch this. What might be some of those? Or maybe there's
Yeah.
not.
Yeah, no, it's a good question. I always think it's context dependent, or maybe not always, but frequently. Um, Simplistically, like the first thing I would say is I try never to have a super strong initial opinion on a CEO or a management team. And because what I want to do is I want to grade them through time. I want to look at their history, grade that, and try to develop more of a quantitative approach to, instead of saying, because I think my experience as an institutional investor was people would talk like, we invest in good businesses with good management teams. Well, who doesn't want to do that? And how do you define what is a good management team? And isn't it also true that I've definitely had the experience of, I thought this was a really good management team, and then they did something really insane or stupid. And so I'm trying to have a system that is more open to constantly adjusting. So trying to quantify it, but also being open to, well, that's what I used to think. This is how it's evolved. And I kind of feel like somebody had this question, which was, how many companies do you own where you like the business more today than a year ago? I think that's a great litmus test when you're evaluating your management team, and try to constantly be, what are the little things? So one of the things that I pay attention to is how they use the word I and we. So, and the context that they use I versus we. So if things are going great, I generally think a good leader is going to praise other groups in the business or other individual people, and not really take any credit for themselves. In challenges, complete inverse, right? I want to hear them own their problems, right? And even if it, clearly is the CFO's job or the COO, whomever, if they own it, I like those kinds of things. I think there's another thing that is like, I'm just gonna, there's a couple different levels to this, but a lack of ownership, which is, I like CEOs that own stock, and or their incentive is set up as they execute, they will own more and more of the business. So they have an incentive to own more of the business. So that's one piece. Then I would say there's own their ship. And what I mean by that is, are they in command of their ship, their business? Do they have a good crew on their ship? And it, is it organized? They know what's going on. And are they developing the talent so that as the business gets bigger, they've got the right people in the right seats? Because when it's small, they might be just fine. But as it grows, they've got to be able to diffuse that leadership structure so they can't be micromanaging all the different things.
Right.
And then the last thing on own their ship is something I already alluded to. Again, I'm trying to keep it PG-13, but when things go south, do they own their ship, except with a T, right? And I think the other thing I just really paying attention to, are they curious? As because I think if you're curious, you have a bias towards learning. And I think when you're curious, that's a skill that's needed in terms of, as the business evolves, you can evolve with it as a person, as a team. And I think curiosity, you can encourage it in the organization, or you can tamp it down. So if the leader is curious, you have a better propensity within the organization for the organization to be curious. So I've kind of rambled there, but those are a couple things that I look for. I guess I haven't said I'll say no, but I guess over time I'll develop no on things if I'm not seeing it.
Based on those. All right. I've written a few of those down. I like those. Chris, any sort of strong opinions when you come across something that you just say no?
What's the old Supreme Court justice? You know pornography when you see it. It's one of those things. You kind of know it when you see it. But one thing that always kind of irks me is a CEO that says, all I need to do is get 1% of this gigantic market. If we just get 1% of this gigantic market, or 2%, pick your number, it doesn't matter. To me, it just reeks of build it and they'll come. And I've seen it so many times in small and micro cap where you build it and nobody comes because they don't understand the value proposition. They don't even know it exists. There's more to being a successful company than look how big my TAM is. Okay. So that one, if I hear someone saying that, that's like nails on a chalkboard for me every time. It's not an immediate no, but man, that's nails on a chalkboard for me. Another one that I don't like to see from a management team, same thing with Andrew, is I don't like to see no ownership in what you've done. I've also kind of recently glammed on to, well, I'll take a step back and I'll say, I spent a lot of time talking to management teams. I think it's important for everyone to understand that a management team is a cheerleader for their company. You're not going to get the full gamut of reality from a cheerleader. You're going to get the best perspective, the best light. So it's important to be able to read someone. It's important to understand when someone's maybe being a little bit over their skis in a situation. And I don't know that you can do that without actually sitting down and talking to them face to face. At least I can't. So seeing that kind of overly optimistic projections is kind of concerning to me. Another one that I love confidence, I love optimism, but there's a line. It's that pornography line, right? At some point, it's too much. And you got to be able to pull it back a little bit and make it realistic. So those would be the ones that kind of come to my mind immediately. There's a few others, but I'll leave it at that and let JP.
Yeah, go ahead, JP.
I just one thing, so it's like people say things, and then people do things. Do we judge them based on what they say or what they do? One way we've kind of over time developed. So not only can you tell if management team's in touch with their business or not, but it also tells you a lot about what they really think about the forward prospects of the business. Is reviewing their capital allocation decisions and their policy. A lot of times, so first off, the management team, that's one thing they have control of. And maybe it's management and board, but either way, they're sitting there and they have the option to reinvest in the business. They have an option to acquire new businesses. They have an option to return cash to the shareholders. What are they doing? Why are they doing it? And I think through having that discussion with the teams, you can really get a sense of whether they're in touch with the internal and external opportunities within their business? Do they view those more or less attractively? Do they have a history of doing the right thing or the wrong thing with respect to capital allocation? And by the way, no one's going to get it exactly right, but just does it have a logical framework to it? I think you can tell a lot about what's going on behind the scenes and whether or not the management team's in touch or not based on their decision-making process. And of course, Andrew and Chris, you both touched on it. If you have ownership in the business, those capital allocation decisions matter a lot more. You go out and do if you're a $500 million market cap business and you go out and do a $200 million acquisition, you know, that's a material transaction. And so, you may have just essentially used the last 3 years of cash flow, plus maybe some debt in order to make that deal happen. Well, that's materially changing the business. You really got to get your arms around those decisions. And I think having that discussion with the management team with the understanding that the future is always uncertain, but just what was the rationale? What was the thought process behind that? And you can get a pretty good feel for whether or not how in tune they are with the business. You also learn a lot. A lot of times these people, in microcap, they either founded the business or the business has been under their care for a long time. And you can really learn a lot about how the industries have changed and where the management team thinks they're going based on their capital allocation policy. So that's just one other thing. A red flag would be a series of poor capital allocation decisions, right? Yeah. So sometimes you see these companies, which is really unfortunate. They may not be profitable yet, and they're basically financing their growth through just continued dilution. Those are things. Those are pretty clear things. But then maybe the next level is just really understanding what the stated capital allocation strategy is. That's how these companies can generate a lot of value over time if they do that right. Easier said than done, of course, but having that discussion helps us get our arms around the situation a little more.
All right. Good insights there, guys. A question I always like asking in these panels, and I think each of you somewhat just touched on it, but maybe just if there's anything else that wasn't touched on, throw it out there. What advice do you give to CEOs, CFOs, anyone that is the face of a company to investors? Maybe it's how their presentations are constructed. Maybe it's how their conference calls are conducted. The types of news press releases that they issue. Should they put everything out there? Should they focus on things that are more important? What sort of general advice, if you were sitting down, and Chris, I know maybe you can start off and you do talk and sort of somewhat consult with a lot of these companies, as you said. What are some of the main things that you would advise companies as it relates to sort of their IR strategies?
The first thing I'd say is if you don't know how to do it, bring in help, because it doesn't help to scream into the void. All right. And there is a technique to talking to institutional investors. And really, that's who you want is institutional investors. They're going to be the ones that drive your share price ultimately. Yep. So if you don't really know how you're doing it, ask for help. There's Lytham Partners out there. There's a bunch of others, but ask for help. They can help you. The next thing I'd say is make it easy for investors to understand your business. No matter how complicated it is, try to make it as easy as humanly possible for people to understand your business. That starts with make your investor relations tab on your website easy to find. Make the web calls or the earnings calls easy to get to. Make the PRs easy to find. Get them to all the global news wires, the PR news wires. Make it easy on investors. By and large, investors are lazy. And if they have to do a lot of work, investors are often just looking for a reason to say no. It's not, to JP's point, there's 2,500, 3,000 names. I got to sort through them somehow. Don't make it difficult on me to find the information that's exciting about your company. So put it in front of me, put it on a silver platter. And then the next thing I would say is take every opportunity you can to talk to investors. Finally, when you talk to investors, this is hard, but try to put yourself in their lens. What is it that they care about, right? Every investor is a little bit different. But if you ask a few questions, you can figure out, are you a value guy? Are you interested in catalysts? Or do you care about this quarter? Are you a long-term guy? When you start to understand who the person is across the table, you can answer questions that, let's say, will influence whether they're likely or not to buy into your company because you're talking in their language. Right. So that's what I would strongly suggest for management teams, those couple of points.
Andrew, anything to add on there?
It's interesting just to dovetail on what Chris said and make it easy. There was a presentation I saw by Adam Epstein. I think you can find it on YouTube, but he just talked about exactly that. He talked about the cocktail test, which is essentially go to a cocktail party. You're the CEO, go to a cocktail party and give them like those first couple, 3, 4 sentences that kind of describe what you do. Let them read it, right? And then take it away, come back to them like 5 minutes later, and then have them tell you, what do we do? And just there's like 2 or 3 questions, like, what do we do? Is it interesting? If it's interesting, why is that interesting? And most people, if you've done a good job, they can tell you right away, this is what you do, this is why it's interesting. And if they can't, like, that's a you problem. You need to change how you describe yourself. And it's exactly like Chris said, make it simple, right? Don't make it like this super complicated, esoteric, industry specific, acronym heavy description of what you do, right? So definitely, I think a lot of companies could benefit from that. I think too, I think sometimes companies get asked questions, and I think it's just okay to say, you know what, I don't. It's either that doesn't deserve an answer, or do you have any more questions? Just move on. Like, it's like if you're asking about a company about M&A and they haven't done M&A in 10 years, I just think that's a stupid waste of time. If I'm CEO, I just say, do you have any more questions? Just move on. Another thing is, I think there's a quote, I want to say it was Robert McNamara, could have been somebody else, but it was something like, not everything that counts can be counted, and not everything that can be everything that can be counted counts, and everything that can't be counted can count, or something like that. But basically it's this idea of, you provide metrics, but is it really information? And so, like, an example would be, like, if you're a CPG company, people might be paying attention to how many different stores are you in, right? Well, every store is not the same. If you're at Joe Blow's grocery store down the street, that is not the same door as Costco or Walmart or Target. Like, those are very different. And so it can be fun to track how many doors they're in, but how much information is actually in that. CPG is kind of interesting because there's a bunch of different metrics, and there's many that can be super valuable inside the business, but externally, another would be like average items carried. That's a perfect example where if you've got a bunch of different items and there's a wide variance on the price point, like if you're putting a lot of low price point stuff, that's not super good information versus, really high priced items. And then it goes back to the retailer itself, they're not all equal. And so those are some nuances that get missed. And so I think you just need to be really thoughtful about the metrics that you provide should provide us as investors information over noise.
I think that's very appropriate, very helpful there. JP, maybe the final word here?
Yeah, I'll keep it short. I think those are all great advice around messaging, and which is really important. Building your shareholder base, a long-term base, I think that's really important. Just one other thought I had is, sometimes you'll talk to companies and they're growing rapidly, things are going great, and maybe things weren't going so well in the recent past. And just one thing I always think about is, before you go hit the road and talk to all these different investors, sometimes it's helpful to kind of clean up the house and get the balance sheet in order, and really make that crystal clear to everybody. And I think about the company that has grown tremendously, and now stock's in a much better position. maybe it's smart to proactively have a line of credit for continued growth, or
Right.
just be thinking about those things, because then otherwise they come up in discussion, and if the companies can be one step ahead and really be thoughtful about that next leg of growth, and I think that's really important, especially before you hit the road and go talk to a bunch of different people.
Yep.
So stop at that.
No, that's good. We're kind of here at the end of the time, but we'll go just a minute or two over. Final outlook for the next 12 to 24 months in the small cap space here. This is where we play the video in a year or two and see if you're right or not. JP, you get the first shot.
Yeah, and I'll be brief. We're very, very optimistic about the future for small cap, given the valuations are incredibly inexpensive relative to large cap counterparts, and especially companies that are already profitable and have strong balance sheets within the small cap space. We think the last 5 years, it's been a story of the baby getting thrown out of the bathwater. I don't know when this valuation spread reverses, but if you look over the last 100 years, this happened before. Typically gets unwound at some point. Is it in 5 months? Is it in 3 years? Who knows? But we're optimistic from the place we stand right now for the next 5 years, next 10 years. We like the forward outlook for these companies that have in a lot of cases we feel like have been neglected by the investment community. So
very good. Chris, you get the next take here. Uh-oh, do we lose Chris there? We may have lost Chris. He may be frozen. All right, Andrew, you're going to get the next take.
Well, I'm very optimistic that in 12 to 24 months, tariffs won't be the topic du jour. We'll probably more likely have moved on to something else. But I think similar to JP, I'm optimistic that kind of I'm definitely for my core portfolio. I'm looking for great performance out of them, over the next 12 to 24 months. Microcap is, for me, a super interesting space because there's so many different ways that you can kind of win, so to speak. And so I think it is a sandbox that you can find good investments that can work, even in environments where overall, the market may not be working, but that doesn't mean you can't find individual investments that can outperform. So yeah, that's all I got.
All right, very good. Well, look, let's go and wrap it up. I'll give everyone a chance to do a little bit of a plug here, talk a little bit about their fund here if they like, and maybe how they can get in touch with you if you're interested. So, Andrew, why don't you begin?
So Odinson Partners, you can reach me at Andrew at Odinson Partners. Odin is the Viking god of war, right? So my dad's name was Odin. So it's just a play on words. So that's where Odinson comes from. So just Andrew at OdinsonPartners.com. Hopefully that's memorable. I'm concentrated, so less than 20 stocks. I am focused on microcaps, but I'm super happy to continue to own a micro cap to a small cap to a mid cap to a large cap. It hasn't happened yet, but I'm super happy allowing that happen. But the focus on new positions is in micro caps. And then I have concentration inside of that. So my top 5 holdings are going to be, 50, 80% of the portfolio at any given time. So I've got a decent, I would call it, farm team or companies that are in that on deck circle. And that's definitely something I'm always kind of thinking about is what season the individual investments are in. And, am I planting enough, and where are things that are kind of higher on the maturity curve? So yeah, that's a little bit about us.
All right, JP, on your side.
Yeah. So yeah, you can contact me at jp@gurneegroup.com. And it's basically the background of our fund. We are the flagship fund is called Lux Fund, and the idea behind Lux Fund is, Lux is Latin for light. We're illuminating these opportunities that are otherwise not really known. And so, as you mentioned, Robert, at the beginning, my colleague and I, Tom, had run a very similar strategy for Columbia Threadneedle and BMO before that. We've been doing it for quite some time. Tom actually incepted the microcap fund at BMO in 2007. So we've been doing this for quite some time. We went independent in 2023 to focus on this particular market. We were managing a lot of different strategies for Columbia Threadneedle. We found this strategy in the microcap space to be by far the most valuable for clients. We left to just focus on this and really give clients the best possible opportunity to create some excess returns. And so we have a 3-person investment team. We're based in Toledo, Ohio. Feel free to reach out to me. We are chipping away every day and trying to grow our fund and provide some great returns for our clients.
Fantastic. And Chris, quick plug in the last 30 seconds here or so.
Yeah, sure. You can reach me. I have a Substack. It's unloved and underfollowed. I also have one that's called the Small Cap Report. So a lot of quant data. I also write on 4 to 8 stocks a year there that typically I own them, but not always. But unloved and underfollowed kind of highlights how I think about the world. I'm looking for in weird corners for things that other people don't look at. And I try to put them together into an interesting fund. Like JP, run a lot of different strategies. Small and micro is one of them. And certainly the one I enjoy the most, I definitely am the most passionate about. But take a look at our website also. It's 1035capital.com right above my head there. So feel free to check it out.
Fantastic. Well, guys, I know we went a little long there. Thank you so much for the time today. Greatly appreciated. Found informative. Hopefully everyone else did as well. So look forward to future discussions. And again, thank you so much for participation in the conference here.
Thanks a lot,
Thanks for the
Robert.
invite, Robert.
Thanks.
Thanks, guys.